Discuss the macro outlook and the investment themes as rates sit just below 5% with Meli, founder and CIO at Monticello Capital Partners, joining us from the New York Stock Exchange. Ollie, welcome back to the Schwab Network.
Thank you. Thank you very much for having me.
Appreciate that. Want to jump right into one of the things I see in your notes. There's such a good point, which is that a lot of money that is still parked in the fixed income category might be there to stay. How much do you think the run-up in yields we got this year induced some more of that T-bill and chill type approach by the market?
I think essentially like the money that is on the sideline, as people like to call it, dry powder, it is not as much of dry powder, because when your money is earning 5%, that is, people need to have a lot of reasons to put money to work. You can think of it as, in 2007, the money on the sideline wasn't really eager to jump because rates were much higher. By 2009, 2010, when the Fed had cut rates, that's where the money on the sideline become more active in the market. And I think that T-bill and chill team is going to stay for a while when it comes to money that is sitting in the money markets, as well as money that might be sitting with banks in terms of CD and brokered CDs.
It's a really important point that unfortunately kind of takes one of the arrows out of the quiver for stock bulls in some way, because I hear a lot of bullish investors say, well, we got all this cash money on the sidelines. Okay, well, how do you define it? Oh, it's in T-bills that are generating 10 times what they did 5 years ago or whatever. Like, it's a totally different conversation, and it's not really as, it can be as liquid. It's generally easy to get in and get out, but what's the temptation when you can lock in 4, 5, 4, 8, 5%?
Exactly, and I think we see that essentially the indifference point where you look at where you need to discount cash flows as an equity investor, that is going to essentially push those discount rates higher. And I think part of the question out there is also where the 10-year is going to be, because on one hand, the Fed is continuing to support the Treasury market. They announced last week that they are reducing the pace of quantitative tightening, which is essentially, when you reduce the pace of quantitative tightening, it's a form of quantitative easing. And by doing that, they are on one hand reducing the supply of 10-year treasuries because they are now selling less, and that is on one hand easing the financial conditions. Equity markets are rallying, fixed income markets are rallying, spreads are at all-time high. And I think that's a policy mistake by the Fed, because it's going to come and bite them back. It is going to be much more difficult for them to fight inflation. And we had essentially a client briefing 3 weeks ago where we said, because of the way the Fed is easing the financial conditions and essentially keeping its balance sheet size to be too large, they are they are making it much more difficult on themselves to fight inflation. So I'll keep an eye on the CPI release next week. We have been seeing for the past 3 months, the CPI has been coming hotter than expected. Always there is an idiosyncratic explanation. But housing inflation is relatively high. I don't think all the elements of housing inflation has been captured and reflected in CPI, so that component of CPI is going to stay high. And as CPI continues to have these hot prints, that might be a counterbalance to their quantitative, to the lack of quantitative tightening, which is going to push the rates higher.
It's an important point on housing because it's a bit contrarian. I think one of the strongest, or maybe not the strongest, but the most common argument I hear for further disinflation is that rents are going to be coming down, as we've seen a little bit of cracks in the job market, and that rents surged in such a way post-COVID that's basically unsustainable. It calculates on a slower rate of change than other inflation metrics. What's your response to that those rents are going to come down, Ollie?
It's a very good question. So, I mean, there are different sectors of the market. Not all real estates are the same. And we have had historical supply of multifamily housing hitting the market. It's if you look at the chart of the amount of housing units that are coming to the market, it's going to go high. But on the other hand, we have a growth in inflation, a growth in population driven by immigration that is creating demand for housing. And that will probably keep so far there is limited evidence of rents cooling down. If anything, if you look at essentially housing component of inflation, which is 36% of CPI is driven by housing, that has shown a roughly 20% growth since the beginning of COVID. If you look at home prices, that has shown a 40% growth since start of COVID. And there is, I think, some catch up to do. And again, today, when you see that if people are making decisions between renting versus purchasing a home, renting is far more attractive given where the mortgage rates are. So it will take a lot for rents to come down. And on one hand, the more the Fed makes mistakes, I think, that are adding fuel to the fire by slowing down the pace of quantitative tightening, the harder it is for rents to come down. Essentially, the inflation that we are facing, the deficit spending, all of them are going to create pressure on rents. And we are so far not seeing evidence of housing component of inflation coming down.
If that's not going to come down the way folks hope, then it definitely reduces the potential for overall disinflation, because we're seeing pretty serious stickiness in some of the more staple-like non-discretionary items. They've maybe stopped going up, but they're not really coming down. So where does the math leave you, Ollie, in terms of the floor for CPI or whatever inflation metric you prefer? What might we expect to be the short-term floor, maybe here to the end of the year?
I would expect to see prints closer to 4%, especially some of the base effects is going to kick in the second half of the year. And it has been interesting few months, because every time there is an inflation release, CPI release, market sells off. Every time there is other kind of releases, earning release or employment numbers, the market rallies. I think we might see that tug of war between, on one hand, inflation causing a little bit of, I wouldn't say alarm, but wariness, and pushing the probability of rate cuts lower and lower. If anything, there is a possibility that with a couple of more hot inflation prints, we could see a rate hike being on the table as opposed to a rate cut.
So in short, because we're out of time, you think the market's wrong here the last week in repricing the cuts back up after the data we got?
I think it has been a little bit too optimistic in terms of repricing the cuts. On the other hand, there are obviously some technical reasons. If you look at the options market, before there was a 30% chance of rate hike implied in the rate option market, and now that has gone significantly lower. And then there are other factors that could be impacting the market for rates. Because, for example, when Japan intervenes in the FX market, what do? They sell their treasuries to essentially buy yens and sell dollars against that. So when they are doing their intervention, that is creating supply of treasuries. So some of the intricacies and technicalities that come from the currency intervention could also be pushing the back end of the curve wider, and maybe some of them also might be pushing the front end of the curve tighter. So I look at both FX as well as yield markets together, and also take into account the FX intervention that foreign banks and foreign players might be doing.
Understood. Sounds like a Bank of Japan reference there, perhaps. Ollie, thank you very much for your time. A good, I would describe it perhaps as a contrarian take based on some of the optimism we've seen from the disinflation crowd. So we appreciate the analysis. Good stuff.
I'm very glad to be here. Thank you so much for having me.
Absolutely. Ollie Meli, founder and CIO at Monochill Capital Partners, right? Offering a little bit of a different look at where the housing role of inflation is going to play out over the coming months.